In the world of personal finance, knowing where your money comes from, where it goes, and how to make it work for you is like having a superpower. If you don't know anything about personal finance, don't worry. In this video, I am going to summarize an ebook, The Beginner's Book to Personal Finance. This is a book written by Robert Kiyosaki, and it provides the guide to your personal finance. So without further delay, let's dive into it. We all have dreams. Some people dream about having a super cool house, others dream of having lots of money so their kids can go to a good school, and some dream of taking it easy and retiring early. Dreams are like wishes for all the awesome things we want in life. But this modern day, all the dreams are attached with the finances. And without having a good finance, it is very hard to achieve those dreams. At the beginning of the book, Robert Kiyosaki mentions that he and his wife achieved success through a simple method called pay yourself first. So what does pay yourself first means? This is a way to prioritize your financial saving and investing. Robert and his wife Kim distributed 30% of each dollar that came in into 3 different accounts. First account was the saving account where they put 10% to save themselves from unforeseen emergencies. The second account was investment account where they put 10% income so that they don't miss the great investment opportunity. The third account was charity account where they put another 10% of the incoming money. Kiyosaki mentions that paying yourself first philosophy might look easy in theory, but practically it's not that easy. Apart from paying yourself first, you'll also need to know how you can budget your personal financial statement. Many people budget their finances by putting their income and expenses in a sheet. While this could be helpful, but it still won't show you the clear financial picture. Personal financing can be divided into 2 parts. The first part will show you the income and expenses. This is where most of the template spreadsheets ends, but it is essential to have the picture of your financial statement, which shows the direction of where your money is moving and whether it is making you rich or not. The first part of your personal financial statement should include all your source of incomes and expenses. Incomes can be divided into 3 subcategories. If you have regular salaries, that should be put in ordinary income. If you own any assets such as real estate or business that gives your regular income, then it should be included on passive income. Similarly, if you are earning through stocks, dividends, interest, and royalties, those incomes should be included on portfolio income. All of your expenses should be included in your expense section. This will give you the idea of your overall income and expenses. The second part of your statement should include your assets and liabilities. If you have more liabilities than assets, then you are going to have a hard time getting rich. In the book, Kiyosaki states that saving isn't investing. Instead, saves are the losers. This might be a little confusing as the first point covered that you should save your income in different bank accounts. Well, it is true that you should distribute your income for various purposes, but you shouldn't depend fully on savings for your financial security. Imagine you have a piggy bank where you save money. Over a time, your piggy bank will get fuller. When you look at your piggy bank, you might feel happy, but the tricky part is, while your piggy bank is getting fuller, the prices of toys, candies, and other stuff you like also go up. This is called inflation. So by saving money, you might be losing your money rather than gaining. Saving by all means is not bad in all way, but saving and hoping it will make you rich is a false hope. In the contrary of saving, Kiyosaki emphasizes that investors are the real winners in personal finance. To understand this, we need to go back and understand that assets make you rich. So, as an example, many people misunderstand home as an asset. But home is not an asset as it takes out money. Assets are something that put money in your pocket. Saving money might not give you much interest, and often what you do get can be eaten up by inflation. On the other hand, putting your money into properties can be a smarter move. Properties can give you monthly income, tax benefits, and the chance to use the value of your property for more investments. Another important thing to understand in personal finance is that you should know and learn to use the debt. Ideally, there are 2 types of debt, a good debt and a bad debt. If you use the debt to purchase the liabilities such as cars, vacations, personal homes, etc., it is a bad debt. Good debt is used to purchase assets that put more money in your pocket each month. These are things like investment properties, capital investments in your business, investments in product development, etc. Good debt lets you use other people's money, OPM, to buy things that bring in cash. It's like investing with a mix of your money and borrowed money. This way, you can boost your profits while still enjoying the returns from your investment. It's a clever way to grow your money without putting all your own cash on the line. Now we know the difference between good debt and bad debt. How can we get the debt itself at the start? It is important to understand that the key to good debt is having a good credit score. The higher your credit score is, the better is the chance to get the debt. So you should know key factors such as the number of accounts you have, the types of accounts you have, your used credit versus your available credit, the length of your credit history, and your payment history to keep your credit score high. The easiest way to improve your credit score is to reduce your bad debt and pay creditors on time. If you can control your emotional expenses, you can avoid making quick purchases that might harm your credit score. If you keep doing emotional purchases, it could be hard to become wealthy. Tax also plays a vital role in your personal finance. For most of the people, paying taxes is simply the part of living in civilized society. While this is true, it is also important to know that not everyone pays the same tax. How much tax you have to pay depends on the type of your income. Suppose if you make money from your jobs, such as wages, tips, and salaries, it is ordinary income, and the tax amount that you need to pay depends on your total annual income. For example, in USA, if you earn in between $0 to $11,000, you have to pay 10% of your income. If you earn in between $11,001 to $44,725, you have to pay 12%, and this goes on up to 37%. But now let's assume you owned a rental property and sold it after some years. This income is called capital gain, and you have to pay tax in between 0 to 20% of the total gain. Similarly, let's assume you owned a rental property and rented it. You'll regularly get rental payments from this property. This is called passive income, and passive income is the income that is taxed very less. So understanding the tax implications of different income sources can help you structure your earnings in a way that minimizes your tax liability. Ultimately, any personal finance philosophy would be incomplete without discussing retirement. Imagine your whole money plan is like building a strong castle, and at the heart of that castle is retirement. We're talking about the time when you decide to take a break from working and enjoy life without worrying too much about money. Rich Dad says, when you're thinking about retiring, it's not just about quitting your job. It's about making sure you've got enough money to live comfortably, even when you're not working. The book suggests investing your money wisely. It's like planting seeds that grow into big, strong trees that provide shade and fruits when you need them the most, during your retirement. Lastly, the book emphasizes being a bit of a money detective. Keep an eye on your finances, know where your money is going, and make sure it's doing its job. It's like being the superhero of your own castle, guarding it against any financial villains. This is it for this video. If this video helped you, please don't hesitate to like and subscribe. It takes nothing out of you, but it will motivate me to make more videos. Comment below and suggest me what kind of videos you would like to see more. Thank you for watching this video patiently. Life is a journey, so keep taking one more step towards your financial goals.